Thank you, Rick. Let's bring in Graham Day now, Chief Investment Officer at Innovator ETFs. Graham, thanks for your time. Let's start with rate expectations, just keying off Rick's commentary. The war against inflation arguably has not been won. Is that what core PCE is going to tell us on Friday? And how could that complicate the path forward for the Fed?
Well, you know, guys, what we're seeing is there is a lot of uncertainty in the market. This inflation has been a trickle-down effect into the economy. What's going to happen with interest rates? What path is the Fed going to take? A few weeks ago, it was all about they're going to continue hiking. Now, with Silicon Valley Bank coming into play, are they going to start cutting? And what we're seeing now is this is translating into the highest record, the highest amount of volatility in the bond market that we've seen since the Lehman financial crisis. And so we are in a very unique stage now. Not only do we have inflation, the uncertainty around the Fed, but we're starting to see more and more economists raising the probability that we will be going into a recession. And so that's calling into question, how do investors position their portfolios today? Traditionally, if they're looking for risk management, it's been in fixed income. But as we're talking about record volatility in fixed income, will the Fed continue to hike interest rates throughout 2023? We have to look back to 2022. Core bonds were down 20 or anywhere from 10 to 20%. They are not providing the type of safety that investors have traditionally been able to achieve in the past.
And does the liquidity tide then turn, Graham? And if that implies that the Fed does need to pivot at some point this year, then what's your baseline scenario on rate cuts?
Well, you know what? We don't have a projection on what the Fed is going to do, but what we can say is that all of this uncertainty in the market is driving people to rethink, what are we doing for risk management? If we're not using fixed income to hedge that downside risk, we're looking into the option space. We're looking at buffer ETFs that can allow investors to stay invested in the market. That's really important. We're not about market timing. We need to stay invested in the market, but we need known levels of risk management in place. That's what we're talking to advisors about today. It's less about what is inflation going to do next month or the next few months. It's more about how can we position our portfolios for the next few years. And the reason for that is because when inflation is coming off such high levels, it does not work through the system in a few months or a few quarters. Traditionally, it has taken years. So we believe we are positioning and helping advisors position their portfolios for a very uncertain, higher inflation environment for the next few years.
So in other words, futures pricing in up to 100 basis points worth of cuts by the end of the year. That's probably not what's going to happen. At the same time, though, Graham, I mean, Sherry and I were watching out for the end of the week Friday, PCE headline as well as the core. That drops. So that's going to be pretty important. But when you take a look at it relatively, Fed funds is actually above core PCE. And the last time that happened back in I think it was 2018, 2019 or so. It was followed very quickly by a Fed cut and much, much easier money. I mean, there's precedent there. There's history for this happening, but you don't think it's going to happen this time?
We think that the game has changed. It's not about the Fed being able to get the Fed funds rate above inflation just for a month or two. This is something where they had record amounts of stimulus going into the economy. Inflation spiked. Right now, their credibility is on the line. And so they cannot afford to let inflation come back above the Fed funds rate. So again, we believe that they are going to be more focused on keeping inflation down for longer. They still have that 2% target, which may change, but we're still a long ways away from 2%.
You got to agree, though, Graham, that if another bank blows up tomorrow, I mean, that scenario of yours just goes out the window.
That's true. That's true. And again, what we're trying not to do is to project what's going to happen over the next few weeks or the next few months. And so for advisors, again, they're not looking at what's going to happen in the next month or two. It's all about how do we position our portfolios and our clients to stay invested. And that's where we're seeing them turn to buffer ETFs, products that allow them to stay invested in the equity markets. And in exchange for an upside cap, they have a known level of downside buffer against losses. And that is where we're seeing a lot of attention for advisors, not only in the U.S. equity markets, but also in international markets. With this uncertainty that we're seeing across the globe, I think a lot of investors are realizing that the U.S. markets aren't the only place to be. It's about relative value and looking across overseas to the international space, the emerging space. We have offerings that allow investors to stay invested in those international markets, but with known levels of built-in buffers against loss.
All right, we'll check out all three of those ETFs. Graham, thank you. Appreciate it. Good talking.
Thank you,
Keep safe. We'll do it again very soon. Graham Day, Innovator ETFs, joining us live.